Cost Accounting by Heather Newton. The basic cost concept is within all businesses, there's a need to see where the costs are going and how to improve the business overall. The term cost is used in many different ways. The reason there are so many types of costs and these costs are classified differently according to the immediate needs of management. As a manager, calculating costs is an important aspect for management. Frankly, a vital piece to any enterprise. As Heather Newton defines it, the cost concept is an application of accounting and costs associated with the products or services a business produces and the activities involved in production process. This includes calculations, measurements, analyzing, and reports. And why is this done? This is for creating projections, plans, and goals, and to see the health and the status of the company at a given time. This is also to help control performance across the board with many different forms of metrics. The important aspect of cost concepts is that the pure management of the company and the progress of the production. Cost concept identifies, defines, measures, reports, and analyzes various information from sales, direct and indirect. Cost concept categories are often categorized by the needs of the company, most often based on expenditure type. The main objective of cost accounting is to compile, analyze, transmit both financial and non-financial information to management for planning, controlling, and operational evaluation purposes. At its most basic, cost accounting measures the economic sacrifice an organization makes to achieve its goals. From Newton. Some of these cost categories include material and manufacturing, labor, which includes direct and indirect, overhead, services for goods or services, administrative, modern costs, management costs. Let's take a look at these categories in more detail. Material and manufacturing costs. This includes the direct materials and indirect materials. As I always ask myself, how much would it take or how much does it take to make the product? There are many different ways to categorize these costs. Any business needs to know the importance of keeping costs separated. Cost accountants collect all costs involved in the process of making goods or providing services and use such data for income measurement and inventory evaluation. This information also helps management plan and make operational decisions. Because of these responsibilities, cost accountants must exercise initiative and good judgment and meet high ethical standards. Further, cost accountants must provide management with information that may indicate adverse economic conditions. When these situations arise, such as reports about poor product quality, cost overruns, or abuses of the company policies. Direct materials is any raw material that is a part of a finished product. A great way to think of this is as using a jigsaw puzzle. All the little pieces are combined to make one large product. This is how direct materials work as well. Indirect materials are the minor details, the glue, the staples, the nails that you might use. These are the minor things that would help put the main product together. Also, when the materials are received, the receiving department inspects the items for quantity and quality, and to ensure that all items have been arrived. Materials then must be stored in a safe, secure, and environmentally stable area until they are used. Finally, inventories must be continually monitored to ensure the steady flow of sufficient materials. As in any company, inventory is highly monitored and watched carefully. Service costs. Service costs include selling, manufacturing costs. This would include the sales tax, advertisement, sales travel, sales commission, sales salary, and cost to even finish the product overall. Not only does the direct cost of materials, but also everything else involved to make this product. So, how much does it take to build or create your product overall? Service costs are the monetary sacrifices it makes to provide the goods or services. From Newton, 2014. Companies that mass produce similar goods, such as chemicals, bakery goods, or canned foods in a continuous production process, use process accounting. These direct materials, direct labor, and factory overhead costs are accumulated for each department for a set period of time, usually a month or even quarterly at that. And the end of the period, department cost is divided by the number of units produced to obtain a cost per unit. And that's where we get the service costs. Labor costs. This includes direct labor costs and indirect. So, how much is your company spending on the first line employees? By that I mean the first line employees are the ones that are actually touching the product and helping create this product. Direct labor costs, for an example, would include the factory worker putting the pieces on the equipment together. Indirect would be the supervisor of that product. Direct labor is specifically the earnings from the factory workers. These are the workers that directly impact the finished product. Only the wages earned by those workers involved in the physical manufacture of the products are direct labor costs. Newton, 2014. Indirect labor. For direct, this is a cost that is only for those who are directly touching the products. For directly. However, indirect, this is the other workers that might be involved in the process, such as janitors, housekeeping, supervisors. Within this, I also like to talk about job order costing, as Heather Newton explains in her article. This is when a product is requested before production, usually with special order or custom-made items. For example, a graphic design company would like to order costing because graphic designers usually produce each design based on specific customer requests. And thus, job costing links all material, direct labor costs directly to a job batch or all direct overhead costs. So everything ties in together. Overhead costs. The overhead costs encompass more than just labor and supplies. This would include insurance, rent, heat and light, property taxes, depreciation. This is more or less the behind-the-scenes operation. So, I have to ask, how much does it take to run the facility? More specifically, one might hear about manufacturing overhead or something similar. Just remember that when speaking about overhead, this usually means the rent, the heat, the lights, property taxes, etc. These mainly are speaking to the reoccurring housekeeping utility costs, sometimes called factory overhead, manufacturing overhead. This consists of all costs that are incurred in production, not marketing or administrating, and are not traced directly to the jobs. Newton, 2014. For an example, the commissions earned by sales or product representatives are generally marketing expenses, while salaries earned by top management are also classified as administration expenses. However, the wages earned by a line manager in charge of overseeing the product, that is factory overhead costs. The administration and executive costs. This includes general management, PR or public relations, general accounting, executive compensation, or even secretarial costs. So, how much is the company spending on indirect labor employees? And this is for all employees that are not directly related to the production of the item. Maybe CFOs, CEOs, CCOs, etc. Any public relation piece, such as newspaper and advertisement, is also included in this. Then we move on to modern costs. This is also known as management accounting, as Heather Newton explains. This is to make concerted efforts on continuous productivity within the company. All of these costs must be factored into the calculations of the final sales price for each product. Again, Heather Newton. She explains that cost accounting tracks these costs and provides the information to management so that management team can make more informed business and administration decisions. For this reason, modern cost accounting is often called management accounting because managers use accounting to guide their decisions. In addition, managers oversee and distribute resources to efficient to meet the organization goals. Managers use the information produced by cost accounting techniques to direct day-to-day operations and supply feedback to evaluate and control performance. So who looks at this information? We're talking about the controllers, the cost accountants, managers, executives. Many different people look at this information on a daily, weekly, even quarterly basis. One of the first to take a look at this information is a controller, and the controller is usually deemed the chief accounting officer or the manager and supervisor in the accounting department. This is the person that projects, plans, and guides the company in the right direction. The cost accountant and the controller work hand in hand to ensure the company is on the right track. The cost accountant, as Heather Newton explains, a cost accountant is a member of the controller's department and is responsible for collecting production costs, preparing accurate and timely reports to evaluate and control company operations. As such, cost accountants are to assemble, classify, and summarize financial and economic data on the production and pricing of goods or services. Also, a company uses this data to review alternative courses of action to select the best methods of achieving its goals and ensuring it has great profit objectives. Managers looked at this information to see where his or her department stands and how they can improve productivity, efficiency, and effectiveness within the department. It is usually the manager's job to project accurately and definitively in order to ensure success in their department overall. Conclusion? Effective cost management is essential for businesses in order for them to provide the best price and service to customers, streamline production processes, and control their investment in inventories. In addition, businesses need systems to track and control costs involving direct materials, direct labor, and factory overhead expenses. These costs are fundamental to almost every single business and comprise a significant portion of costs associated with the production of goods and services. The following explain those basic costs in more detail, which we already discussed.